If you have spent any time researching how to grow your wealth, you have likely run into a frustrating roadblock. You know that picking individual stocks is a statistical gamble, and you know that leaving your money in cash guarantees a slow loss of purchasing power to inflation. You want to buy a broadly diversified portfolio, but when you log into a brokerage account, you are hit with a wall of confusing acronyms, minimum investment requirements, and complex trading screens. You might have thousands of dollars ready to deploy, or you might only have $50 from your last paycheck. But the friction of actually getting that money into the market stops you in your tracks. This paralysis is the exact problem a specific financial innovation was built to solve. Today, we are going to unpack the ETF. We will examine what this tool actually is, how it fundamentally modernized the way everyday people invest, and exactly how you can use it to build a highly efficient portfolio without needing a background in finance. Before we define the mechanics, we need to clear up a widespread point of confusion. The philosophy of index funds says, buy the entire market instead of searching for a single winning company. Because of this, many beginners assume that an index fund and an ETF are two completely different investment strategies competing against each other. This is a category error. An index fund describes what you are investing in, a specific list of companies. An ETF describes how that investment is packaged and sold to you. You can buy an index fund packaged as a traditional mutual fund, or you can buy that exact same index fund packaged as an ETF. The strategy is the same, but the vehicle delivering it to your portfolio is entirely different. ETF stands for Exchange Traded Fund. To understand why it is so powerful, we have to look at those two components separately. Let's start with the fund portion. Similar to a traditional mutual fund, an ETF is a pool of money collected from thousands of different investors. The managers of this fund take that massive pool of capital and buy a large basket of underlying assets, usually stocks or bonds. When you buy a share of an ETF, you are buying a proportional slice of that entire basket. To understand the logistics, think of the global shipping industry. Decades ago, loading a cargo ship meant manually packing thousands of individual, uniquely sized boxes, barrels, and crates. It was incredibly slow, labor-intensive, and expensive. Then, the standardized shipping container was invented. Suddenly, goods could be loaded into one uniform metal box that easily transitioned from a truck to a train to a ship, reducing friction and drastically lowering global shipping costs. An ETF is a financial equivalent of a standardized shipping container. Instead of forcing you to individually buy and manage shares of 500 different companies, an ETF packs all 500 companies into one standardized ticker symbol that you can purchase with a single click. This brings us to the exchange-traded half of the name. Unlike traditional mutual funds, which only process trades once a day after the market closes, an ETF trades on major stock exchanges exactly like a regular share of a company. You can buy or sell it at 10:15 in the morning or 2:30 in the afternoon. The price updates by the second. To see why this structure is so beneficial for the everyday investor, we have to compare it directly to its predecessor, the traditional mutual fund. First, consider the barrier to entry. Many traditional mutual funds require a minimum initial investment of $3,000, $5,000, or even $10,000 just to open a position. If you are a young professional trying to start small, you are completely locked out. Because ETFs trade like individual stocks, the minimum investment is simply the price of one single share. Today, many modern brokerages even allow you to buy fractional shares of ETFs, meaning you can start investing with literally $5. Second, consider tax efficiency. Due to a complex internal mechanism called in-kind creation and redemption, ETFs are structurally more tax efficient than mutual funds. When investors sell out of a traditional mutual fund, the fund manager often has to sell underlying stocks to pay them out, generating a taxable capital gain that gets passed on to everyone else still holding the fund. ETFs bypass this process almost entirely. As a result, if you hold an ETF in a standard taxable brokerage account, you will generally face fewer unexpected tax bills at the end of the year. Finally, there is the issue of transparency. Mutual funds are only legally required to disclose their exact holdings on a quarterly basis. ETFs, by contrast, publish their exact holdings every single day. You can look up an ETF right now and see precisely what companies your money is supporting down to the decimal point. Let's translate this theory into a real-world timeline to see how flexible this vehicle can be for different life stages. Consider a 40-year-old project manager who spent her 30s paying down aggressive student loan debt. She is debt-free, but feels she is starting her wealth-building journey late. She has a solid income and decides to aggressively invest $750 every month into a highly diversified ETF tracking the top large-cap companies in the economy. Because she has a slightly compressed timeline, we will look at a 17-year window, taking her to age 57. Assuming a realistic inflation-adjusted return of 7.5% annually for this specific asset class, let's look at the math. Over those 17 years, she will contribute $153,000 of her own money. However, because she utilized a low-cost ETF that efficiently tracked the market's growth without the drag of high management fees, her portfolio would grow to roughly $298,000. Despite a late start, the ease of automating ETF purchases allows her to build a massive financial foundation before traditional retirement age. Now, let's apply this to a completely different scenario. A 31-year-old architect who wants to take a multi-year career sabbatical before he turns 40. He isn't investing for a 30-year retirement right now. He is investing for a 9-year medium-term goal. Because his timeline is shorter, he cannot afford massive stock market volatility. Instead of a purely stock-based ETF, he buys a balanced ETF that holds 60% stocks and 40% stable government bonds. He invests $600 a month. Because of the heavy bond allocation, his expected return is a more conservative 5% annually. In 9 years, he will have set aside $64,800. Through his conservative ETF, that balance would grow to roughly $82,000. He successfully outpaced inflation, grew his money safely, and because ETFs are highly liquid, he can sell his shares on his 40th birthday and instantly fund his sabbatical. As we evaluate these scenarios, we must pause to establish the reality of market participation. All investments carry risk, and the value of an ETF can and will fluctuate. You should always review your personal financial situation and consider consulting a licensed professional before committing your capital. If you are ready to implement this, the actual execution is remarkably simple, provided you know what to look for. When you search for an ETF in your brokerage account, you will identify it by its ticker symbol, a 3 to 5-letter code. Before you click buy, you need to verify 2 critical details. First, check the expense ratio. This is the annual fee the ETF charges you for managing the basket of assets. Because the goal is efficiency, you should generally look for broad market index ETFs with an expense ratio below 0.1%. If an ETF charges 0.75% or 1%, they are severely cutting into your long-term compound growth. Keep your costs as close to zero as mathematically possible. Second, ensure the ETF is actually tracking what you want it to track. The ETF industry has exploded, and there are now thousands of highly specific specialized ETFs that only buy companies in niche sectors like robotics, clean energy, or video games. These are highly concentrated and highly volatile. For a beginner building a foundational portfolio, you want an ETF whose stated objective is to track the total stock market or the S&P 500. To wrap up our analysis, the ETF is not a magic investment that guarantees high returns, nor is it a complex derivative meant only for Wall Street traders. It is simply a highly efficient, transparent, and low-cost container. It allows you to buy a deeply diversified slice of the global economy for the price of a single share. It removes the high minimums of traditional mutual funds, minimizes your tax burden, and allows you to automate your financial future with incredible precision. Building wealth does not require you to monitor financial news networks or predict economic shifts. It requires you to select a low-cost, broadly diversified vehicle and fund it relentlessly over time. If this breakdown helped clarify your strategy, consider subscribing for more objective financial breakdowns.